Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is General Motors. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I am the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
Well, Lindsey, if we look at the SPX chart here, it's easy to see that in February we're actually having a decent month, which historically it usually is not. What do we see going into the middle of February in the S&P 500 index?
Well, we're only 2 days in, but I'll take the two big green days that we've seen so far, especially after what we got in the month of January. January ended up down 1.1%, so it was a little bit of a rough start to 2021 for the S&P 500. But like you said, so far February is looking a little bit stronger. We've got a ways to go in the month, and it isn't historically a strong month for the market. But we'll take the strong start here. What's driving action today? Well, after a positive day yesterday, we're seeing a lot of green again today, and it's really being driven by two things: stimulus and vaccinations. And so what we're seeing on the vaccine front is we're seeing the US actually moving from being a laggard in the vaccine race to really being viewed as with people getting more of the vaccine than in any other country. The average doses being released per day in the US is averaging about 1.3 million, but over the last 3 days, that has increased to over 1.5 million people getting vaccinated on a daily basis. So that's really great news. It's a story of the reopening of the economy and returning to normalcy, or what we used to know as normalcy. So that's certainly a positive. Also, we heard from Pfizer this morning that they're ramping up their delivery of the vaccine to the US too. So that's certainly a positive. On the stimulus front, yesterday we got the GOP's plan. They are requesting a $600 billion stimulus plan with $1,000 checks for individuals. So that's a lot less than what the Biden administration had initially proposed, the $1.9 trillion plan that they're looking for. But we don't know exactly where the cap is for the GOP. This could just be an opening bid. It'll be certainly interesting to watch. Interestingly, though, the market didn't react negatively when that news came out yesterday. I think it really is a signal more so to the marketplace that there is a potential for there's potential for a deal to be done here, and that stimulus will be coming to the market. Right now, the expectation is that we'll get that stimulus by March. So March isn't that far away. It could be a spring awakening maybe for the marketplace and the economy if that stimulus does come to fruition. Like I said, with the vaccine, you're starting to see new daily cases drop off very sharply here in the US. Deaths are still elevated, but that lags new cases. So that's going to be a positive. So together, working in tandem, this could be a really positive sign for the economic environment. And that's why I think you're really seeing the market move up today. Also, yesterday, we heard from the CBO, Congressional Budget Office. They expect a rapid recovery in economic activity and GDP. They expect that to recover by mid-year 2021. That tags on to what the IMF said recently, too. They raised not only their GDP growth expectations for the US, but globally in the past couple weeks too. And then when you add to that the fact that the Fed support is still there in the marketplace and is expected to continue for quite some time until we see inflation run hot for a longer period of time than we have seen in the past, I think those things all really bode well for equity markets. And then, Brian, also, it's not just those types of things that are running the market right now, too. We've got We're in the midst of really assessing the fundamental situation for corporations, and in that we are in the middle of earnings season. This is the second busiest week of earnings. We're seeing something like 106 companies report for the week. 40% of the S&P 500 has reported so far, and of those companies that have reported, 77% have beat on the bottom line, so their earnings are better than expected, and 75% are also beating on sales. That means the sales number is really important. Usually on any given quarter, you see sales beat by about 55% of companies beating on the top line. So this number is a lot better than expected, and that bodes well for margins going forward, because usually as the economy recovers, companies are a little bit slow to reinstate expenses. And so that bodes well for the margin recovery, at least in the near term, while they're able to get their footing under them and understand exactly how the recovery is taking shape. That's a story that we're going to continue to follow. But the disappointing part about this earnings season, Brian, has really been that stocks aren't reacting positively to good results. And what we've actually seen is the average S&P 500 company has declined about 70 basis points, or 0.7% on the day they report earnings. The biggest sector being hit is the consumer discretionary sector, declining 2.4% on average the day they report. That might all change though this week, because tonight we're going to get Amazon reporting results. We'll also get Google, Alphabet reporting results after the bell. Those two will be really ones that we're going to watch closely, because the other FANG names, the other big tech names, they all reported solid results, but the stock reaction wasn't too positive. It was kind of more neutral, I'd say. But overall, the information technology sector, their reaction has been flattish to down slightly on the day of the reporting. And the healthcare sector too, we're going to get a lot of those companies this week. They've been the only sector where we've seen the stocks react positively, up about 1.1% the day they reported. Within that mix, of course, J&J, Brian, we've talked about J&J before. They had a solid report come out last week. And so their stock moved higher. McKesson is a distributor of drugs, is another one that had a good earnings report. And IDEX, which is their company that provides products for animals. So that's also been a hot area. They reported earnings this morning that were much better than expected. So you're seeing that stock pop today. So that's what's going on in the marketplace. I will say it's been a positive trend that we're seeing the S&P 500 yesterday close above its 50-day moving average again. But Brian, the other positive development, I think, in the marketplace too has been the VIX, which we always take a look at. It's come back down a little bit closer to that 20 level. Last I looked, it was at 26. Interestingly, when I looked back at history, Brian, what we've seen is the VIX, when it moves up sharply, like it did last week, between Monday, Tuesday, and Wednesday, we saw the VIX move from, I don't know, the 22 range to 37. That's a really sharp move in just 3 full days. And now we're back down to 26. But when you see sharp moves like that, historically, it's been a positive for the market overall in the 1 month and 6 months following that type of move. So what do you make of the move lower in the VIX, Brian? How should we read into that? History tells us it's a positive sign.
Well, overall, we are seeing the VIX make that type of move. But the one thing that I see in the back months in the futures, if we go all the way out to April, we had that pop up above 30 in the VIX, as Lindsey mentioned, and I'm going to highlight it here. This is actually a VIX chart, and you see that pop all the way up to it really struggles to get above 40 in most instances. Since the pandemic, there's only a few times where we even came close. But we did have that type of move, as Lindsey mentioned, the last few days. Now we are coming back down. Now, the biggest thing about these moves is that we're moving quickly to the upside, but slowly to get back down to I guess, what would be the new norm, right around the 25% level, especially when we look at the back months. When we look at the February, we got, April, March, we're still at the 28 and 29% level. And we've talked about this on almost every stock play of the day for the last couple of months, is that the futures contract is looking for more volatility as opposed to less volatility. And now we're kind of getting that in the marketplace. We've been setting a lot of record highs in the SPX, in the Russell 2000 index, also in the NASDAQ, but the VIX was just not coming down. And we're still seeing that nervousness in the marketplace. So it kind of says to me that whenever we get some type of a downturn, we are getting a lot of professionals running to the options marketplace to give yourself some protection. So there's still a lot of nervousness in that marketplace overall. It's good that we came down 4 points today. So this is one of the first times we've had a good run, I should say, a jump up in the VIX, and we've taken it off precipitously to the downside, right? So we're down 4 on a solid move today to the upside, but we're still trading around that 26 level. And if I look out to April, we're all the way up to 29 in the VIX index. So that nervousness is still there. Every time we get a positive move to the upside, the VIX still means that there are a lot of people out there just worried about where the marketplace is going. And it's anytime we get any type of bad news overall, we usually get a solid move up in the VIX in general. All right, so today's stock is General Motors, symbol GM. We have a chart here in General Motors. We have earnings coming. What do you see going out in time in General Motors?
Yeah, General Motors is our stock of the day. But before I get into the fundamental analysis and take a look at this chart here, I just want to remind everybody that Brian and I do take your questions live at the end of the show. So be sure to ask us questions in the chat box. I see we already got a couple questions coming in. That's really great. Keep them coming. We love talking to you guys at the end. We love to know what's on your mind. So looking at GM, this is a stock that Brian and I, we've just been keeping our eye on because, I mean, look at that move into the start of the year. It's been phenomenal, right? But we have recently seen a pullback. So on a year-to-date basis, the stock is up 23%, and that compares to the S&P 500, which is only up 0.5%. This is through yesterday's close. But I will say that the stock on the right-hand side, you see a little bit of a pullback. That peak that we saw in the stock happened on January 20th. And since then, we're down about 6%, even with the recent little bump there on the right-hand side of the chart. This is, GM and Ford, they have actually performed very well throughout the course of the pandemic. Automakers originally were expected to be one of the sectors that would get hit hard in the aftermath of the pandemic, with so many people losing their jobs and worried about being able to pay for cars. But it turns out that people wanted to turn to owning their own car instead of using public transportation, given the aftermath of the pandemic. So we've seen the stock perform really well, but also the other thing that's happening within these names is they are starting to become more focused on electric vehicles and autonomous driving. And I think what you've seen at the start of this year too is really these stocks are starting to finally get credit for that effort and that strategy to evolve their company in the years ahead. Now, interestingly, with GM, one of the biggest announcements that they recently made was last week, and they said they are expecting to have an all-electric lineup of vehicles by 2035, so in 15 years from now, and they're expecting to be carbon neutral by 2040. So ambitious goals, and they kind of put a stake in the ground on those goals too. And so it really solidified their path forward. I think it helped the stock move to those January 20th highs, and kind of come back from, actually it was January, I think they just announced that at the end of last week. But they have had several other announcements on the way that helped boost the stock coming into this year. And they announced an investment from Microsoft more recently. Microsoft is investing in their Cruise business, which is their autonomous driving business. GM owns 70% of that business. So that's one thing that they'll be able to benefit from going forward. it's just the pace of these announcements, especially at GM as well as Ford. Yesterday, we got news from Ford about a partnership with Google, using their cloud to really drive some of the technology within their cars. But the pace of these announcements has really increased for both companies, but especially GM. And so that's certainly an encouraging sign. And I think, like I said, what you're seeing is investors are actually starting to believe that this story is true, and that these old automakers, these old stodgy automakers, are actually going to be able to keep up with the likes of Tesla and others that are entering the EV space and really fulfilling the customers' interest and desire to have electric vehicles on the road. So finally, when I look at the fundamentals, you know me, I'm always looking at the price to equity ratio, the valuation of stocks. And the valuation here, it's not bad. It's at about 7.5 times on a forward PE basis, price to earnings ratio basis. That's compares to its historical average of 7 times, but that historical average doesn't take into account an evolution of its strategy to become this EV and autonomous car maker. And so a lot of analysts on the street, on Wall Street, are saying, hey, this thing, it could actually be worth something like 14, 15 times. And if that's the case, then you can expect this stock to move a lot higher. Of course, the question is going to be, will they disappoint along the road to 2035? So this is going to be a closely watched company, closely watched stock, given the move that we've already seen in the past year, up 56%. But the valuation does look like it's in its favor. So Brian, these guys are reporting earnings on February 10th. So at the end of next week, what kind of paper trade can you put on in that period of time? I don't know if you're thinking of doing something before they report earnings, or you're going to wait till after they report earnings. I know you always are looking at the type of expected move in the stock based on the earnings date. So what are you thinking?
All right. So whenever we look at earnings, like we did last week when we talked about Apple going into earnings, it's more of a FOMO trade. In other words, we're going to use options to try to manage some risk of an earnings report, but also if the earnings are good, because we're going to be a little bit bullish here on GM overall, we don't want to miss out. We don't want to miss out on the move to the upside if it does happen. And we're going to do something very similar. Last week, we looked at a long call spread, partly because in Apple, the volatilities were a little bit higher, and you also had a little bit of a higher price stock. So this week, in General Motors, we're going to look at just buying an in-the-money call and limiting our risk a little bit by doing that in-the-money call and ride it through earnings. And then if you wanted to get long General Motors at that point in time, you can either exercise that call option and buy the stock, or you can sell the call option and then go out and use the proceeds to help buy the stock overall. So it's a fear of missing out. We're going to use options as they were first intended. If you're thinking about buying 100 shares of GM, we're going to buy one call option, and we're going to go a little bit in the money because earnings have pumped up the volatility a little bit. By going deeper in the money, you're getting more intrinsic value, and you're paying less vol premium, i.e. time premium. Basically, they're one and the same. So the strategy is going to be a long call, and we're going to try to find some delta. So here's the Ally Invest Options playbook. With the long call option, what's important is, are you going to buy some intrinsic value, or are you going to speculate more and just buy some out of the money option contracts? In this instance, on our paper trade this week, we're going to go a little bit in the money. We're going to buy a little bit of intrinsic value. So let's see how that will look in the Ally Invest option chains. So we see we're highlighting the earnings here. On the left-hand side, we have the calls. On the right-hand side, we have the puts. We're going to go out to the February expiration, which is the 19th. That would be the Friday after the earnings report here on the 10th. And that means that we have 17 days remaining. So if I look at the chains on the call side, we highlight that here's the delta. So I want to get something that acts a little bit like the stock. We're buying it as a surrogate for the stock. If I have an 80 delta, that means if the stock goes up 1, my option contract in theory should go up about 80 cents. You get about 80% of the stock price movement by buying that option contract. Now, it's a little bit more expensive option contract, but if we look at this, we see that the option is 520 by 535. So you're talking about 10% of the stock price. Now, that is a decent amount, but that's where your risk is limited. That's the most that you can lose on that trade. So if I look at the stock today, we're up about 1.5% at this point in time. If we buy this option contract, we are putting up about 10%, a little over $5, about 10% of the actual current stock price. And that will be our official paper trade overall. So if I look, I got the long straddle in here. Let me remove that real quickly. So our official paper trade would be to buy the 48 strike call option, pay around, we'll try to work it a little bit. It's 520 by 535. So we'll pay around 530 for that. And I'm going to make that in the right rail. We'll put it right in the right rail. And this will be the official paper trade for the week. And I'm going to put the limit price at 530, trying to work the order a little bit. Never guaranteed a midpoint fill if you're doing it. But with option trading, you're always putting limit prices in. Even if you're buying it at the market, you would make the limit at that market price. It's just a good habit to be in when you're trading option contracts. Okay, so we're buying open one contract, i.e. this is a surrogate for buying 100 shares of stock. The February 19th expiration, 48 strike call. The limit price would be a $5.30 net debit. You'd hit preview order, send that down to the floor. Now, as always, especially around earnings, this is not meant to be a recommendation. It's just a paper trade. We're just looking at how might I approach this. If I was thinking about buying GM during the earnings season, how might I approach it and use options to try to limit my risk a little bit on the downside? Now, I'm going to highlight a couple of things. First of all, to start with, I had the long straddle highlighted here. So there's an alternative trade that we can do to this. And that trade is actually called a fig leaf. I'm going to show you that inside the options playbook. But if I buy this option contract and I look over at the put side of it, I see that I have about, let's call it 90 cents worth of time value in there. Now, going into earnings, I really don't want to cap my upside. So if I get a good move to the upside, I'd like to know what the marketplace thinks the move could be. And the marketplace would look at, if the way that we want to try to track that is look at the most at the money option contract. If you bought the call and you bought the put, and you scroll down, we'll look at our workbench here, we see about a 5% move is what the marketplace is actually looking for here. So 5 points on the upside. If it moves more than that, it's moving more than what the marketplace expected. So if you really wanted to, you could go out and actually sell a call 5 points or more above where the current strike price is at. And if you did that, you are capping your upside. And it looks a lot like a covered call position because we have a lot of delta. We have a deep in the money option contract. And then the fig leaf would look like this. And that would you would be selling about as much time premium as you're buying. So you're trying to offset that entire time premium susceptibility that you have in your option strategy. Now, I prefer to do this after earnings. I'd rather cap my upside after earnings. But if you want to, this would be an alternative strategy overall. So today's paper trade in general is just buying a long call. We're going to go a little bit in the money on that trade overall, and we're going to ride it into earnings and see what happens after the earnings announcement, and then make a decision there if we still want to buy our 100 shares of GM. All right, Lindsey. Okay, so if you have any questions, please put them in the chat box. In the chat box, and we'll address them at this time. So, do we have anything that going on in the chat box?
Yeah, we do, Brian. We've got some good questions too. I'll start at the top. Stein 3D. Hi, how are you? He asks, is it fair to say that earnings beat right now are more of an effect of conservative estimates than positive growth? Could that explain the earnings sell-off trend at all? I would actually say, Wall Street analysts, they do like to set the bar low historically for companies to beat. And that's why you do have historically high beat rates for earnings per share. Usually the S&P 500 66% of companies will beat on the bottom line. We're seeing a better number this quarter, but I went back and looked. Earnings expectations, the estimates, they haven't moved much since the beginning of December. So that tells me that, the earnings weren't kitchen sink at all going into this reporting period. So the bar wasn't set aggressively lower than it should have been. But we are seeing companies report a lot better than expected. I think the real reason that you're seeing this sell off in some of these stocks after they're reporting is because, and it's why Brian probably picked the trade he did today, is because what we have seen is that a lot of these stocks have run rampantly in the last 2 or 3 months coming into the earnings period, coming into the start of the year. So given that fast and furious move for a lot of these stocks, and when the numbers come in good, it's become what they call a sell the news type of event where the number is good, so it warrants the profits that or the return that the stock has achieved so far. So people are taking profits, and so I think that's more what you're seeing happening than this being just a really low bar. So that would be my answer there. Thanks for the question. Wayne, he's back. Hi, how are you? He says, great seeing you on CNBC last week. Thank you. It was a fun time being with the gang there. Brian, he has a question for you. Can you show us how you would calculate the total daily theta decay on GM using the REIT?
All right. Well, if we're looking at theta, it's not a part of our chains. Okay, so theta decay is, there's a Greek that tracks theta. And that Greek overall shows you each and every day how much decay you would have in your option contract. Okay. So now the strategy that we looked at, we know that we have about $1 worth of time premium. And that's using my quick and dirty little trick in that if you're buying an in the money call, the amount of the put is approximately the time value. So let me put this back in the workbench. And if you want to see the theta decay on a position basis, this is what we have in our option chains that's available for you. And that this option contract, if we were to buy it, we would pay, well, it's down a little bit. We approximately $525 for it. Each day that goes by, on that entire position, the theta decay is about $5.80 overall. Every day that passes on a 17-day option contract, we got that $1, that 90 cents or $90, about $5 worth of it would decay on that position. And this is net theta. Now, this is on a position basis. It's a little bit different than if this was the actual theta number, it would be 0.058. That would be 5 cents as opposed to $5 overall. So this is where you would find theta inside our option chains. We only show the actual delta on the chains, which to me is a more sought after number than theta would.
Okay, a follow up to that, Brian, from Joshua Trader is, he says he can't find the premium on the Ally options chain. He wants to start selling covered calls. Do we have the premium?
Well, the premium, that would be the price. Overall, if I'm looking, so I'm a little bit confused by the question a little bit. If I'm buying this option contract and I wanted to sell something like I talked about the fig leaf strategy, a 90-cent option contract, what I would look to do is just pay that 90 cents, right? So if I'm buying this option contract and I wanted to do a fig leaf and I knew that I had 90 cents worth of time premium and I wanted to make it about equal, I would just go down and look at the out of the money call option and the premium in this is 90 cents. So I'd maybe look at going a little bit further out of the money if I was doing the fig leaf here in this scenario. That would be an alternative strategy. But the price or the premium of that option contract is highlighted right here by just getting the quote inside the option chain.
Yep. Okay. Gotti B asks, what would be the difference between buying the 48 or 49 strike? Like, how do you make that decision? I think it's a good question. I think a lot of our viewers struggle with that. Like, how do you decide the price to go?
Well,
premium?
I'm looking at delta. In this instance, I want something that represents a lot of the stock price. So for example, I looked at something that had about 80 delta. Now that delta has moved a little bit because this is a dynamic chain. So in this instance, I'm looking at, excuse me, I want something that's going to give me about 80% of that underlying stock price movement. And how do I reference that? I reference that by looking at the delta. As a matter of fact, after this move, after the stock's just moved a little bit here, I might think about buying the 47.50 because I get a couple more deltas. If you think of it this way, You think of delta as number of shares. This is how market makers actually use delta. They use delta to try to determine how many shares they need to buy or sell to hedge their position. So in this instance, if I buy an 80 delta, it's like getting, as opposed to the 77 delta that I'm highlighting here, it's like getting 3 more shares of stock to start with, right? Because if the market goes up 1, this option contract's supposed to go up 80 cents. This one's only going to go up 77 cents. So if it goes up 80 cents, I'd make $80. If it went up 77 cents, I would make $77 overall. Now, these are all theoretical numbers, but this is the best that we can go with, right? That's the one thing about option pricing, is trying to have a realistic expectation as to what the underlying will move when the underlying stock, what the option contract will move as the underlying stock moves overall. So it's all based off of delta.
Do you
and actually, I highlight that.
Delta? Is that what you usually look for? Or it depends on the stock or the underlying?
I'm sorry, say it again, Lindsay, I interrupted you.
This is my question. Do you usually go with the 80 delta or, or is it more related to the security that's underlying the option contract?
The underlying stock will matter if it's an expensive option contract, but that also adjusts the strategy too. So last week we looked at Apple. Let's talk about that trade. Instead of doing a deeper in the money option contract overall in Apple, we chose to do a long call spread going into earnings. And part of that reason why is that the option contracts were much more expensive because Apple's a more expensive underlying. It had a little bit more volatility. The implied volatility is about 30% higher in Apple last week going into earnings as opposed to GM this week. It was around 80%, and GM was right now around 50%, if I recall. So in general, that adjusted our strategy. We looked at a long call spread because of that going into earnings, as opposed to GM, where I'm more comfortable buying a deeper in the money option contract. I'm only paying $1 worth of time premium, and maybe I'll sell a call against that position after the earnings announcement overall. So yeah, the delta does matter. And I can highlight this, Lindsay, real quick, because I know we're running out of time. But if you want to learn more about delta, let's look at the Rookies Corner inside the options playbook. And it's just called Buying Leaps Calls as a Stock Substitute. That addresses delta and why we picked an 80 delta overall.
All right, awesome. We do have 2 questions, but I think they're really quick. So I'm just going to give them to you, and I think you can give quick answers. Okay. Wayne has a follow-up question. When you add the fig leaf, is that making the trade a bull call spread?
Yes, especially in this instance, it would make it a bull call spread. You are correct. If we added that call to this position, and in my example on the option chains, I'm going to go back to the chains here and making our producer jump around quite a bit. Let me highlight, right here. So if I'm doing this and I'm using the same expiration, where I am buying this option contract and I'm going to sell something that's got about the same amount of time premium, right around the 58 is what I would look at. Now that would actually be a bull call spread. And that's correct. When you actually, I don't think of it as a bull call spread because we're so deep in the money on the long option contract, but that would actually be a more correct definition of the strategy.
All right. And Samson Chick, how can I tell if an option is undervalued or overvalued?
Well, that's relative. That, especially going into earnings, that's hard to say because if you say it's overvalued or undervalued, what you're saying is that the implied volatility number right here, I'm highlighting it. It's a 58% implied volatility on this option chain. You're saying that the marketplace is getting that volatility wrong going into earnings. And so that's a hard one to say overall. You'd have to get into statistical models and everything that goes around with it. Usually as a retail client, I look at an option contract, and if there's a known event that's going on, I just want to know what the marketplace expects. And then I'm going to adjust my strategy accordingly. I know this isn't a short answer, but we highlighted it. Going into earnings, what is the expected move? Look at buying the most at the money long straddle. And the marketplace is basically saying that if we buy that call and we buy that put, which means there's no regard to direction, that the marketplace thinks it will move around 5%. If it moves more, it did the over. If it moves less, it did the under. But that is what it's telling me. And I take that information and I decide, okay, now how am I going to use that to pick my strikes when I'm doing my trade?
All right, great. Well, that's going to do it for the show. I will give a shout out to Joshua Trader. Thanks for subscribing to our show. We definitely recommend everyone else do that. Click on the bell and subscribe. But he's going to execute his first options trade on the Ally platform. So very good. We wish you luck with that trade. Keep us posted. But that's going to do it for our show, right, Brian?
Yep, that's it. So we'll see you this Friday for the Stock Play of the Day Overtime Edition. And as Lindsey said, please click subscribe and ring the bell. Thanks for coming.